So Tom Lee just said on CNBC a few moments ago, you want to be bullish for May, if not the rest of this year. He said it's time to turn bullish. This is in regards to what we have seen over the past couple of days in our markets. Meme stocks have resurged, and the markets generally have been doing pretty well. In fact, maybe Tom Lee is correct. If we get a CPI report that is in line with estimates, if not lower than estimates, stocks could go through a pretty big rally this summer. We also heard from Fed Jerome Powell today, as well as Loretta Mester, which happens to be one of, if not the most hawkish Fed officials. And what she had to say is a pretty strong indication of a better than expected CPI report coming out tomorrow morning. So let's go ahead and get into it. Let's start first with Tom Lee.
I think it's time to get bullish. Stocks really have been consolidating for the last couple of months, and I think the conversation you had is correct. The data has not convinced hawks or doves which way inflation's breaking. And I think once we get a decisive data point, and potentially it's tomorrow, I think that $6 trillion of cash comes off the sidelines, and I think stocks break out of this range. And I mean, that's our bet that, May ends up being a very strong month for stocks, even better than it's been already.
What's this rally about? Why don't you tell me in your own words what you think this is about? Why did we rebound so quickly? And why are we now on the doorstep of a new closing high for the S&P?
Well, I think that markets kind of had a very sort of simple framework in their head, which is as soon as inflation accelerates, the Fed switches from dove to hawk and tries to crush the economy. And I think Powell's been very clear in all of his recent statements that, look, inflation is not just this core headline number, and it's not just a services number. It's these three moving pieces: housing, auto insurance, and everything else. And they've been playing a waiting game. We're seeing that even in some of the recent articles, and Powell talked about it, and a lot of folks are talking about auto insurance. I think once that turns, and it possibly, because if you look at PPI, insurance actually rolled over pretty hard. I think it's going to make it clear to markets that it's not just hey, inflation is stubborn. It's really this, inflation is now normalizing. The economy's in good shape, and rates are so restrictive, the Fed actually needs to cut rates. And that's actually quite good for stocks. Look, if it's a pause, actually it's good for stocks. If it's a cut, I think it's even better.
I mean, I was looking at the sector activity today, Tom. I mentioned at the top of the program, up volume was way outpacing down. Even earlier today, when it was hard to get much, if anything, going, there was only maybe one or two sectors that were green. Now almost everything is green. Tech is having a great session here. That is now, leading the way. A lot of the names there are green. What are we to make of this new closing high for NASDAQ, especially after some of the rollover that we saw, in the month of April in those names?
I think it's really good news. I think a lot of folks thought this was a ninth inning market expansion or, an extended rally. But I think the revival of meme stocks and the fact that there's still a huge amount of cash that's been accumulating on the sidelines in the last couple of weeks shows you, look, I think there's still a lot of legs to this rally. That's why I think May could not only be strong, but of course, as stocks could do very well into year end.
So Tom Lee is not just bullish for the month of May, he's bullish for the rest of this year. Again, as I have made very clear here on this channel, the economy will take precedence over the Fed. The question really becomes, does inflation soar again, causing the Fed to raise rates? Thus, what does that do? The Fed raising rates does nothing in and of itself. It pushes you closer to a recession, right? As you restrict economic activity. That's why stocks sell off when the Fed raises rates. Now, to the contrary, as long as the economy stays okay, it doesn't even have to be fantastic, but as long as it's okay and it doesn't look like there is a recession coming and the Fed starts to cut rates, that actually lowers the odds of a recession. So if tomorrow's CPI report comes in lighter than expected, you'll actually potentially lower the odds of a recession, because at that point the Fed should have a lot of room to start cutting rates. Now, Jerome Powell spoke today and he gave us a pretty big insight into maybe what to expect coming tomorrow. Now, just to summarize what Fed Jerome Powell said today, he basically said the same old, but he did sound very confident that inflation is falling back to 2%. He went even as far as to say you don't have to get service inflation down to 2%. You can see housing fall and then non-services housing, your three core baskets of inflation, fall, and that could, well, offset some of your persistent higher inflation in the service sector. Jerome Powell also yet again reiterated today that the odds of raising rates again are very low, that in the worst case scenario, I shouldn't say worst case scenario, that would obviously be huge rate hikes, that's a worst possible scenario, but in the more base case scenario is just the Fed is going to be higher for longer. They're going to give it some time, let policy work itself out to eventually get inflation back down to 2%. What was very interesting about today is Jerome Powell had this speech, and he already knows what the CPI data is because CPI comes out tomorrow, and Jerome Powell has been very clear. The Federal Reserve presidents, central bankers, they get these inflation reports a couple days before the markets do. And judging off of the speech from Powell today and the 3+% rally from Tesla, as well as the 0.64% rally in the NASDAQ, that is telling you that tomorrow is going to be a good day for stocks, and your inflation report's probably going to come in lower than expected. It's actually not too often that you get a speech from Fed Jerome Powell the day before CPI or the day before a major data point is released. What's also very interesting about today is you had Cleveland Fed President Loretta Mester that gave this speech today. Now, Loretta Mester is by far the biggest hawk on inflation that we have seen in recent months. So judging on what she says, that can also be very important. And lo and behold, what did she say today? Well, she said, quote, "It's too soon to conclude inflation progress has stalled." That is directly suggesting that inflation's going to come in lower than expected tomorrow. That's her way of just saying it's too soon to conclude what's going on. Whether inflation is stalled and going to rise again, or whether inflation is going to fall. I mean, if we were going to have a bad CPI report today, Loretta Mester would have said inflation is stalled. That's what she would have said. She said it before. She's a hawk. The fact that she did not say this is a very strong indication inflation is going to come in lower than expected tomorrow. Loretta Mester says she thinks the central bank can wait comfortably for evidence inflation will resume a downward trend. That's a fancy way of saying, hey guys, I already know what the numbers are. I can't give you too much details because I'm not allowed to, but we're in a pretty good spot. But Loretta Mester said policymakers needed to be prepared to move to a more neutral interest rate bias in its official communication if inflation stopped declining in the months ahead. She said, quote, "I would prefer not to have to raise rates from the current level, frankly." She says, because I think we saw some of the effect of having to be aggressively moving rates up last year when three mid-sized banks failed. And let me just read you this whole quote here. She said, quote, "If inflation continues at the level it is and doesn't show progress, I think the committee will have to think about what would it take to say, okay, maybe we need to increase rates. We're not there yet. I'm not even convinced that we're not on a downward path." She also said this determination about whether you want to hold at the current level for longer versus could we have to raise interest rates, it's the inflation expectations. Stability in that is going to be key for me in that kind of determination, said Mester. Mester said long-run measures of inflation expectations appear to be reasonably well anchored at levels consistent with the Fed's 2% goal. She also said that some businesses have reported remorse over not having raised prices more aggressively last year. And she said she was carefully watching whether companies might try to preserve margins with larger price increases this year. Evidence that businesses were changing their pricing behavior in that fashion would be a sign that we have less stability in inflation expectations than we think, because people are embedding higher inflation in their decision making. So there is clearly a lot of moving parts with inflation, with the Fed, with the economy, but judging off of Powell and Mester today, I don't think we should look forward to a higher than expected CPI number. If anything, it's probably going to come in lower than expected. Now, if you guys are everyday viewers of this channel, you know I believe the economy is not doing that great. I don't think it's necessarily entering into a recession right now, but I think you're on the path towards that. If you are an everyday viewer of this channel, you already know as well that inflation is simply the ability of companies to pass on costs to consumers. If consumers are not doing well and they're not spending as much as they were and they're starting to cut back, like a McDonald's, a Starbucks, and other companies have mentioned on their last earnings calls that just happened, that's not an environment in which you tend to see inflation thrive. Now, this time around, inflation's kind of weird because a lot of it is in housing, owners equivalent rents, which is basically a survey of asking homeowners what they would rent their homes for. So the data that we kind of get for CPI is weird already, but I don't think it's, headed down a negative direction, because I don't think the economy is as strong as a lot of people believe. Now, just to be clear, core month over month is expected at 0.3% tomorrow. There is a high number and there is a low number, and it gets rounded, whatever it is, to 0.3. So what I mean is, if inflation really comes in at 0.25, it gets rounded up to 3. Even though you're going to see 0.3% here, the markets will react a lot different to 0.25% or 0.34%. And that number getting rounded down to 0.3%. So if you get rounded down, that's not great. If you get rounded up, that's much better. Now, core CPI year over year is expected to come in around 3.7%. Last month was 3.8%. Inflation on your headline month over month is expected at 0.3%. Last month was 0.4%. And your headline year over year is expected at 3.5%. Last month, you were also at 3.5%. Now, tomorrow morning at the same time inflation comes out, you will also get retail sales month over month. That number is expected at 0.3%. Last month was 0.7%. So when you're comparing month over month, 0.3% compared to 0.7% last month is still not a bad number. That's still a very strong number for the economy, right? If you come in low, the markets are probably going to like that. Like 0% or slightly negative. If you come in like really negative, markets are not going to like that. The odds of rate cuts will definitely increase, but the odds of a recession will also increase, and stocks generally don't like that. I think there's also a couple moving parts with the data tomorrow. You have retail sales, you have economic data, and you have CPI data. Now, you get a bunch of other data as well. Not just retail sales, not just CPI. New York Empire State Manufacturing Index is expected to be -8. Last month was -14.3. Retail sales year over year are expected to be 3.8%. Last month was 4%. You have the NAHB Housing Market Index expected at 52. Last month you came in at 51. You have retail inventories as well coming out at 10 o'clock in the morning month over month, expecting that to actually be negative 0.1% month over month. Last month you were positive 0.4%, and this is excluding autos. So that could be a pretty big number as well. And then you will get Fed Bowman that speaks at 3:20 p.m. and Fed Kashkari that speaks at noon. You do have a bunch of oil data, some rig counts as well. And then foreign bond investment coming out at 4 p.m. and then overall net capital flows as well coming out at 4 p.m. tomorrow. After hours at 7:50 p.m., you will get GDP growth rate quarter over quarter for Japan. That could be important because Japan is the single largest owner of U.S. treasuries. So if Japan is doing well or not doing well, high inflation, low inflation, all of that can have implications for our bond market. So I think all of this data feeding a narrative will definitely be important for tomorrow. Again, judging off of the last couple of days, the resurgence in meme stocks, like Tom Lee said, and just the overall rally we've seen in the markets in the past week or so, guys, it is suggestive of inflation coming in at expectations or lower than expectations. Tom Lee said a couple days ago that inflation just coming in line with expectations is good because that would still be a drop from last month's number. And that's also true. Last month's core number was 0.4%. So even if you come in line with expectations of 0.3%, that's still a fall on a month-over-month basis, right? That's still a drop. If you come in at 0.2% now, that's really good news for stocks. So let me know what you think about all of this information down below in the comment section. Are you bullish? Are you bearish? Are you worried, excited? Let me know how you feel about tomorrow down below in the comment section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.